Most people think investing is about finding the next big stock. Charlie Munger believed the opposite. He once said, "The big money is not in the buying and selling, it's in the waiting." And the reason most people never become wealthy is simple. They can't think clearly, they can't stay patient, and they don't understand how to avoid stupid decisions. Today, you're going to hear 10 powerful rules that guided Charlie Munger through decades of successful investing alongside Warren Buffett. Rules that helped build Berkshire Hathaway into a trillion-dollar empire. Rules that can help any ordinary American, whether you invest $50 or $50,000, avoid costly mistakes and grow wealth over time.
Rule 1. Think rationally, not emotionally. Munger believed emotion destroys wealth faster than a market crash. When the market goes up, people get excited. When it goes down, people panic. Munger didn't. Example: during the 2008 financial crisis, while millions were selling, Berkshire bought shares of Goldman Sachs. Why? Because Munger looked at facts, not fear. Takeaway: don't let headlines drive your decisions. Look at long-term value, not short-term drama. Rule 2. Only invest in what you understand. This is the circle of competence principle. Munger never touched businesses he didn't understand, especially early tech stocks. Example: during the dot-com bubble in the late 90s, everyone was pouring money into internet companies with no revenue. Buffett and Munger stayed out. The bubble crashed. They didn't lose a dollar. Takeaway: if you don't understand a stock in 5 minutes, don't invest in it. Rule 3. Look for durable competitive advantage. Munger invested in companies with moats. A moat protects a business from competitors. Example: Coca-Cola. People thought it was boring. Munger thought it had global dominance, loyalty, and pricing power. He was right. Coca-Cola became one of Berkshire's best investments. Takeaway: choose companies that will survive the next 20 years, not the next 20 days. Rule 4. Be patient, very patient. Munger made money by doing almost nothing. He said, "You don't make money when you buy. You don't make money when you sell. You make money while you wait." Example: Berkshire held American Express for decades. One decision, years of compounding. Takeaway: wealth grows quietly over long periods of time. Rule 5. Avoid stupidity instead of chasing genius. Munger's philosophy: trying to be smart is overrated. Avoid being stupid. Real example: he avoided companies with weak management, high debt, or unclear business models. This rule alone saved Berkshire from countless disasters. Takeaway: focus on avoiding bad investments more than finding perfect ones. Rule 6. Demand a margin of safety. This rule came from Benjamin Graham. Never pay full price for a stock's value. You want a discount. Example: if a company is worth $100, you aim to buy it at $60 or $70. That gap protects you from mistakes. Takeaway: the lower you pay, the lower the risk. Rule 7. Study continuously. Munger read 500 pages a day for decades. He believed better thinking leads to better decisions, which leads to better investing. Example: he studied multiple fields, psychology, physics, economics, and used everything to understand businesses. Takeaway: an investor who doesn't study is like a doctor who stopped learning after med school. Rule 8. Don't try to predict short-term markets. Munger warned people against guessing what will happen next week. Example: he ignored daily price fluctuations and focused on business performance. Even Buffett once said, "If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes." Takeaway: ignore noise, pay attention to fundamentals. Rule 9. Think in probabilities. Munger used mental models from mathematics and psychology. He didn't ask, "Will this stock go up?" He asked, what are the odds this business will do well over 10 years? Example, when evaluating Apple, Berkshire looked at customer loyalty, pricing power, and long-term cash flow probability, not just trends. Takeaway, good investing is not certainty, it's smart probability. Rule 10. Stay ethical and avoid people you don't trust. Munger believed character was a form of risk management. Example, Berkshire refused to work with shady companies or greedy CEOs. In the long run, honesty produced better returns. Takeaway, if management is not trustworthy, the stock is not investable. Closing message, last 1 to 2 minutes. Charlie Munger didn't win by being the smartest man in the room. He won by being the most disciplined. While others chased hype, he focused on clarity, patience, and long-term thinking. If you follow even a few of his principles, understanding your investments, avoiding emotional decisions, looking for moats, and buying only with margin of safety and waiting for years, you will be far ahead of most investors in America. This channel, De Facto Investor, will continue exploring the wisdom of great investors like Munger, Buffett, Graham, and others. If you want simple, clear,